I will argue what happened here, it's a long answer to your question, is this is just another step in what I believe has been a very systematic and very targeted attempt to cut off the banking or fiat on-ramps and off-ramps into and out of crypto. And unfortunately, Silicon Valley Bank kind of got caught in the crossfire.
American investor and hedge fund manager Mark Yusko has again exposed the devious plans by U.S. regulators to disturb the growth of the cryptocurrency industry in and out of the country. There have been reports that heads of regulatory bodies in the United States, most notably the SEC's Gary Gensler, are trying to influence their counterparts in Canada and Europe to cut the industry off banking services in a concerted effort to delay the industry's growth. According to Yusko, the ongoing banking crisis is one of the outcomes of the fight against the cryptocurrency industry. In a recent interview with the Paul Barron YouTube channel, Yusko discussed his outlook on the banking crisis and what the regulatory crackdown means for the cryptocurrency industry. Yusko also revealed plans by regulators and top banks to strengthen the consolidation of smaller banks into larger banks. Yusko believes that smaller banks are being offered as some form of collateral damage in the struggle to give even more power to larger financial institutions like JP Morgan. Undoubtedly, we are in the now they fight you phase of cryptocurrency adoption. The crypto industry's continuous survival and growth against all odds are beginning to rattle a lot of nerves, and it will stop at nothing to bring it down. Before we listen to Mark Yusko's assessment of the ongoing banking crisis, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Also, sure you drop your comments and observations on Yusko's interview in the comments section below. Thanks and enjoy the video.
Everyone keeps asking, is this 2008 all over again? Is this another global financial crisis? And, Ms. Yellen, Paul, assured us that there would not be another banking crisis or financial crisis in her lifetime. So she's still walking around. Some say just barely, but she's still walking around. So this clearly can't be a crisis because she guaranteed there wouldn't be. And while it's certainly something, and we can talk about what that something is, I actually don't believe it's a full-fledged crisis the way 2008 was. A couple reasons. One, if you think about how the banking system works, we, the collective we, all take our hard-earned money and we deposit it in a bank, many different banks, and those banks then take that money and it becomes theirs. One of the great myths of the banking system is it's our money. It's actually not. It's their money. It's the bank's money. And you can see it right on their balance sheet. It says their money. Now we, the collective depositors, have an IOU from that banking system. And most of the time, 99-point-something% of the time, it's money good. But when it's not, things start to unravel fast. And, at the end of the game, it was funny. Larry Summers, I guess, was on last week complaining that, clearly Silicon Valley Bank was just a great example of mismatching, borrowing short and lending long.
Right.
So, Larry, you're saying they violated the basic premise of being a bank. I mean, that's what banks do. And this guy was the Secretary of the Treasury, for God's sake. They borrowed short and lent long. Now, the difference is, unlike global financial crisis, where JP Morgan, Citigroup, Bank of America, Wells Fargo should have all gone out of business, right? I mean, their liabilities exceeded their assets. The assets were bad assets, bad housing loans, bad business loans, going to be pennies on the dollar in many cases. This is different. These assets are government bonds,
right?
Which, barring a calamity that would dwarf anything that we're talking about here, meaning like true Mad Max kind of scenario, those are money good assets. Now you have to wait a certain amount of time. And yes, there's a mark-to-market loss, and it could become a real loss if you're forced to sell because of a bank run. I think we're not in a global financial crisis. I think we're in a little bit of a localized panic. Again, I will probably argue that this is intentional by the big banks, right? What we saw was $120 billion leave the little banks and go into the top five. Some might argue they needed that for their solvency ratios and all that good stuff. And concentration of power at the top is the hallmark of all mature kleptocracies or cronyism societies. And you see that in, the number of banks at the top, the number of airlines at the top, the number of, name an industry, it's all consolidated. And that creates this massive wealth and income inequality that we see every day.
During the interview, Barron and Yusko discussed the positions of big banks like JP Morgan since the crisis started and what they stand to earn with the failure of every single bank. According to reports, JP Morgan had $1 trillion in uninsured deposits at the end of 2022. Comparatively, Silicon Valley Bank had about $150 billion in uninsured deposits during the same period, just a few weeks before its eventual collapse. It would be highly impractical to expect JP Morgan's demise overnight, but it does expose another of the many pitfalls in the banking industry. Let's get back to Yusko's interview as he discusses how convenient all this has been for the multinational financial services company.
Yeah, to that point, that's 10 times the level of uninsured deposits at Silicon Valley Bank.
Exactly.
And everybody's saying, oh, look how poorly managed that was. And stop. Okay. FDIC insurance was never, ever intended to be a fully reserved pot of money.
Exactly.
It's kind of like Social Security, right? My mom, to this day, love my mom, but she believes there's a little pot in Washington, D.C. called Judy's money. And I'm like, Mom, there's no pot. There's no money in Social Security. It is a flow-through mechanism.
Yep.
Well, then where happened all that money that I put in? It went to your parents and other people's parents. And who's paying mine? Me and my two brothers. And that's the way it works. And that's okay, except for the little fact that when Social Security was set up in the 1930s, there were 17 workers for every retiree. When I reach retirement age, there'll be 2. I used to joke when I only had 2 kids that, they had to choose between me and my wife and I would lose. So I had to have another kid, which we did. So we had a third kid. Now I'm still only, I'm one to one, and that won't work. But ultimately there is no pot of money. The FDIC has about 4%, somewhere between 3.5% and 4% of total deposits in the system on reserve, right? That's how insurance companies work, because the likelihood of all 100% of the assets in the banking system disappearing is infinitesimally small. I'll argue it's zero, that happening. Now, what about more than 4%? Well, we came close during global financial crisis, and they had to extend some loans. We didn't come close this time. I think Silicon Valley Bank was about 1 or 1.5%. So, but JP Morgan, that's another story, right? That's about 2.5 times what the FDIC has. So if there were a run on JP Morgan, but look, JP Morgan, let's just say they're survivors. My favorite story is Knickerbocker Trust, 1907. They passed a rule saying that trust companies could compete with the banks. JP Morgan was a big bank, and Knickerbocker Trust started doing things well. A lot of people put money in it, kind of like the building loan and Mr. Potter in It's a Wonderful Life. And JP Morgan famously quipped, I like a little competition, and perhaps fomented some rumors about Knickerbocker. There was the run on the bank. They collapsed. He bought all their assets, pennies on the dollar. JP Morgan becomes super, super big. Go back to global financial crisis. Who bought all the great assets? Who bought Washington Mutual? JP Morgan. Who bought Bear Stearns? JP Morgan. It's always JP Morgan. So what happened on the Friday, Paul, this is amazing. On the Friday that Silicon Valley Bank was having the run on the bank, we got a call from JP Morgan saying, hey, would you like to transfer your assets to our bank?
Yeah.
And what, did you send out the list of client accounts to all your, and well, here's the crazy part. The reason we were at Silicon Valley Bank was because we got debanked by JP Morgan 10 years ago because we were too small. There are too many coincidences in my mind for things to not be linked. But I heard, and again, this number may be off, but I heard that JP Morgan opened up 40,000 new accounts.
Mark Yusko is not the only one talking about the intentional regulatory crackdown on the cryptocurrency industry. In a recent tweet, Real Vision Chief Executive Officer Raoul Pal notes that the global crypto industry is facing a very rocky future. The tweet reads, "My best current guess of the global future of the crypto industry. A U.S. regime of highly regulated and TradFi integrated major players, small in number and oligopolistic in nature over time. An Asian regime of one or two key players, CCP approved in global south in nature. A global regulatory arbitrage regime that connects the two worlds but is larger than both. Basically, that is how the existing financial system works due to geopolitics, along with technology and other key economic systems. Capital finds a way. Always." In a follow-up tweet, Powell goes further by stating, "This is why the dollar is 87% of all trade." On his part, Yusko is choosing to remain more optimistic about the future of Bitcoin and the cryptocurrency industry. Here is one of his most recent tweets. "American regulators have mistaken perception that a globally decentralized network can be governed and controlled by one jurisdiction. 80% of Bitcoin is owned by non-Americans." What are your thoughts on Yusko's and Powell's assessment of the situation? Do you think Powell's really gloomy prediction is the future of the cryptocurrency industry? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more insightful interviews featuring the industry's brightest minds. Thanks for watching.